Okay, I want to go on to lecture 2 now in the capital gain area. I want to point out that I'm basically following the slides in the capital gain area that I've posted on your resources. I just did slide 1 through 6 in lecture 1. Now I'm going to do starting with slide 7 and so forth. I say that because I won't always talk about every slide. If I think the slide is self-explanatory or I don't actually have anything to add, then I won't proceed to talk about that slide. So you need to just follow them through. And if I skip a slide or don't discuss it and you have questions, be sure and get a hold of me or raise it in one of our synchronous sessions. So back to my screen. So on the securities, slide labeled securities, the only thing I want to mention is the day trader. I want us to be clear that, again, we have to have capital gain or loss. You have to have an asset that you bought to use. With the day trader, almost by definition, they bought it to sell. They bought securities to sell. It's an inventory item for them. So they won't be getting capital gain or loss. They'll be getting business income or loss in the day trader. With the mutual funds, just mention that any items in the mutual fund retain their character. And the taxpayer will be given information each year about here's the dividend, here's capital gain, whatever. And then if the amounts are continually reinvested, the taxpayer will pay tax, but then they will increase their adjusted cost base. What I want to spend most of this particular lecture talking about is the principal residence exemption. This essentially is an area of the law that suggests that the government decided it really wasn't fair to tax taxpayers on any gains from selling a personal residence, that this is where they live. If they sell one, they're going to have to buy another. So there just seems to be no justice, I guess, to taxing the income from these sales. So essentially, sales of a principal residence are exempt. There's a formula to do the calculation. You take proceeds of disposition, you subtract ACB, you subtract selling costs to get your gain. If you only have one residence, that gain is tax-free. You don't need the formula. All right. And it's literally tax-free. It's not a tax deferred issue, et cetera. They just don't tax the gain and they don't reduce basis, or there's no carryover basis, all kinds of the other things that could cause a tax deferral versus a tax-free gain. You want to understand selling costs include commissions on the sale. They include taxes on the sale, anything that's connected with the sale. Now be aware, if this scenario connects with a move, if we're selling our house for a employment move, pay attention to the moving expense discussion that we'll have with the other income and deductions discussion, because selling costs, some of them can be deducted as moving expenses rather than reducing a gain that's tax-free in the first place. So pay attention to that and make sure that it's in one of our problems. You make sure that you get the selling costs deducted in the right place. All right. Now, what happens that can complicate the principal residence exemption is if a taxpayer sells more than one or even has more than one principal residence. Because a principal residence, the government basically says, you know, if you've been there even for a short period of time, you can consider it a principal residence. And an awful lot of Canadians have cottages or seasonal residences. So they would have their primary residence and they have a secondary residence, however elaborate or uh, casual that may be. So what happens if we have a dual residence situation? Well, the formula that we use, we say, all right, we're going to take the number of years designated We get to simply pick as long as I have lived there, even a day or whatever, that it's been legitimately a residence, a principal residence. I take that plus one. So the formula says, okay, one plus the number of years I pick. All right. And I divide that by the total number of years that I owned, that the residence was owned by me or by the taxpayer. All right. And I multiply that times the gain. That's the exempt amount. So then I take the total gain minus the amount exempt, and that'll give me the capital gain times 50% currently equals the taxable gain. All right. So the item is a capital asset. It was bought to use. It's a residence. That's like if it doesn't qualify as a residence, then all this is irrelevant. And if it qualifies as a residence, it was bought to use. All right. So you get this formula. So what you want to do is think about the designation, even if you only sell one during the year, like you've got a principal residence and a seasonal residence. And this year you're moving. You're going to sell your principal residence, but keep your seasonal residence. So you don't have to be selling them both in the same year, but you want to think, okay, how much gain in total is there of this one versus this one, and what you might expect from this one if you aren't currently selling it. And you allocate years, you designate years depending on what you think will be best. If it's somewhat easier to see perhaps if you're selling both in the same year, and I think your problems do have this, one of your problems, but in any case, what you would do is step one, you calculate the gain for each property sold. And if you're selling more than one, you calculate for each property. Then you figure out the gain per year of ownership. All right. So then you take the higher or highest if you're selling more than two, gain per year, okay, asset, residence. And that's where you'll designate the max. All right, so what you're looking for, the higher gain per year, you're looking to get that one at 100% tax free. All right, so if I've owned the property, say 8 years, what I will do is designate 7. So remember that plus 1. So we have that plus 1 in the formula. So 1 plus 7 divided by 8 equals 8 divided by 8. So you always designate one less than you need. All right. And when we say designate years, let's say I bought in 2000, I go 2000, 2001, 2, 3, 4, 5, 6, 7, that sort of thing. And any year I have designated the higher one, I can't use that year for the lower one. So you have to pick which one you want to designate which years to. But always remember your 1 plus rule, because I can't, there's no point in exempting more than 100% of the gain. All right, so see that in your problems. If you have questions, let me know. You do need to realize that if you change your use of the residence, it's considered a sale. Now there are some exemptions. So like if you leave the country and you decide to rent out your residence, that's a change in use. It's treated as a sale. Now, there are some elections you can make. There are some exceptions. So anytime you're changing anything with your residence, even if you're not selling it, be sure you check in the law and make sure that you can either avoid paying tax on the gain if you want to, or get advantage of the provisions that are available to you. Also realize that you have to report the sales on your T1 each year. In the past, that wasn't true. CRA and the government have decided that they think there's too much abuse of people who are actually buying houses to sell them and make money and claiming their principal residences when they're not, that these people aren't even in the country, much less actually using it as a principal residence. So you do have to report these sales and the exemption amount on your tax return each year. Okay. Another item to mention briefly is the capital gain reserve. There is a reserve available. This is an ability to pay concept. It's a fairness concept again. All right. That if you didn't get all the money from the sale in 1 year, it's only fair that you don't have to pay tax on all the gain in 1 year. Now, there's a maximum deferral period of 5 years. So essentially what you can do is recognize like 20% a year, depending on when you're actually getting the cash. The formula's in the notes and so forth. But there is that reserve again. This is to be fair. It's an ability to pay thing. Capital losses, remember, deductible only against capital gains. And they're only 50% deductible. They do carry forward indefinitely. All right. So the next thing you're going to need to know is the ACB of the assets to we compute the gains and some other odds and ends that we'll talk about. And we'll do that in our next capital gain lecture.